A crude awakening. Oil prices ticking slightly lower this morning as supply concerns ease on hopes Iraqi exports will resume. China's rocky recovery is still seen as the main driver of crude. Investors remain concerned over demand from the world's top importer. Cole Smead still here with us. Cole, despite the possible easing of tighter oil supplies, you're optimistic on the oil outlook. Explain that to us. Walk us through your thesis there.
Yeah, so China used to be the tail that wags the dog, right? What China did, sent marginal commodity prices higher or lower, including in oil. And what you're seeing is just the worst news out of China. And if you don't think it's bad, it's really bad, the news coming out of China. And yet, while this news is becoming greater and more precipitous, and we're hearing about more defaults, delayed payments from financial institutions over there, you're watching oil stay tight or marginally climb over the last 60 days. So I think that really tells us a different story. It's not about China's demand. It's about the tightness of supply. The tightness of supply being that if you look at the futures market right now, you'll find that the futures curve is terribly backwardated, which means that no new supply is going to grow in the next 3-4 years because no one gets compensated to go out and take that risk and hedge it in advance. So I think that's the continued trend we're seeing is just really tight supply. And therefore, as any demand goes on, prices have to edge up or stay firm because there's no one that can produce a new barrel for supply.
And Cole, in your estimation, what is sort of the new threshold that oil would need to get to make supply more attractive for the producers who have been cutting back to start producing more?
No one asks me that question or asks us. That's a great question. The answer is a minimum $100 a barrel, a minimum of $100.
And do you see it getting there anytime soon?
We have to, because this is a growing economy and barrels per day are growing. But as I pointed out a second ago, it's just not dominated by China like it was. So you look at the Western world. The Western world's continued to grow despite all these difficulties in rates and all these inflation headwinds and so on and so forth. So we really look at it as it's $100 a minimum that you have to do that. And where you're going to get production first is from people who are already producing, where they look and say, you know what, it's profitable to go out and poke that hole in that field that we were maybe waiting longer to do. And now we're going to step up that investment. Where do you get a lot of big projects coming online at a later date? You're going to find those above $120 a barrel. But the rationality of the market, people used to say that, oil people will never get religion. They'll never come to know Jesus. They'll never quit drilling. Well, that's just not true. They quit drilling. And to watch an administration that loves renewables begging oil people to drill is just the oddest thing I've ever heard of. It's like stranger than fiction, which means it's true. So I think that those are the dynamics really at play in that market. And one other thing I'll add, it's got to come by Americans and Canadians, because the Europeans, it's like socially unacceptable to get oil and gas out of their ground, even though they have those resources. So we're going to see this OPEC plus, Canada, US, and parts of LATAM. That's the suppliers of oil globally.
Real quick before we let you go, Cole, how do you play this thesis on oil? Do you buy oil itself, or do you buy oil producers, or where in the stack do you buy?
We like the producers because they've just been really left for dead. And that's where the best money was made. The servicers weren't the better place to make money. So I would say you're looking for what they call torque. You're looking for places where a $5 barrel increase of oil gives you a lot of operating leverage and really grows the free cash flow of the business. So you don't want to go buy the majors, generally speaking, because they don't provide a lot of torque. Go look for names that have been more affected by things like gas. We own Ovintiv. They have a higher gas mix. Apache would be another name that I would throw out to people in that space. And then if you go look in Canada, the Meg Energies of Canada and, the Cenovus's that get WCS, a $5 increase in WTI directly affects Western Canada Select blend as well. So you'll see the Canadians will really outpunch their weight as we move forward here because they have more torque than a lot of the American players as well.
Cole, thanks for spending some time with us this morning. If you go back to Seattle, you can get the fish seasoning for Brad, but I'll probably be there first. So,
as long as somebody picks it up for me, we're good.
Thanks, Cole.
Yeah, I missed Top Hot Donuts. That's what I need is a Top Hot donut. So
I don't know that those will make it back with me. Cole Smead, Smead Capital Management CEO. Thank you so much. Appreciate it.